Succeeding in the Indian markets. I never realized I got old enough to be titled as somebody who succeeded in the Indian markets already, but we'll give it a stab. Just the usual risk disclaimers from us. And how do we view returns, or how do I view returns? And when I look at returns over periods of time, and having done this on the buy side for about 17 years, we really look at returns as, one, a risk neutral position. Second is, what is your market, what is your beta? You know, volatility, beta, word it the way you want. And the third is, what is the alpha? I think the key underlying assumption that we're all making in terms of what is your alpha is the assumption that, do you believe that the markets are efficient or not? And my fundamental opinion is that the markets are not efficient. We heard Amit just talk about real estate and talk about cycles in the sector, etc. And perfect example, because that's just an exact example as to what happens when you have a cyclical downturn. And we've seen that in real estate, right? We've seen prices go from, or stocks trading at half price to NAV, etc., going to now way above their NAVs, right? And these are what your inherent cycles are. But more importantly, when does the market misprice stocks? And does that give you a perfect buying opportunity, and how should you look at it? So in my history, what we have done is we have consistently looked to invest in the market at points when stock prices are below the intrinsic value, what we assess is the intrinsic value of the stock, right? Essentially, these are good businesses. These are good businesses going through difficult times, and you will be surprised how many you find along the journey. Something can be happening in the sector, something can be happening in the company specifically. Maruti back in 2012-13, when there was a strike and there was a lockout at the Gurgaon office, Gurgaon plant, unfortunately there was a death of one of the HR managers and the stock dropped. But from a opportunity perspective, was it a great opportunity to buy the stock? Yes, it was. And these are the kind of opportunities. So really, that red shaded area, as you see, where essentially the stock price is significantly below what we think the intrinsic value is. And this really leads us to a point where we really need volatility in the stock. Because only then, in a market where you see that kind of volatility, do you get that kind of mispricing. So volatility is what leads to market inefficiencies, which leads to the opportunities that we are looking for when we are looking to invest in the market. You know, the difficult part about doing what I profess to do is the fact that when there's volatility, when the stock price is below the intrinsic value of a stock, there is always some issue, right? Something is wrong. And at that point of time, you have to take the call that this is transient. This will go away, or this will revert to normal, right? How do you take that call? And you can't do that at the point when something is wrong. You have to build that conviction over time, so that when that opportunity arrives in that stock, when something corrects or something falls precipitously, you know this is the right time to act, or actually this is a value trap, you don't go near it. Those are the key fundamental questions you have to ask for yourself. And to do that, to be able to assess that, you have to know your companies extremely well. So you have to understand what are the drivers of the P&L, what drives the balance sheet, the cash flows, definitely the debt levels, etc. And you have to be able to have done this over multiple quarters, not at the point of time when, something's gone wrong per se. You also need to understand, why has it been mispriced? What is the market assuming at this point of time for which it is mispricing the stock? whether it be, a financial company, whether it be a manufacturing company. We've seen this at various points of time. Hero Motor Corp, 2.5 years ago. The stock was trading at 13 to 14 times 1 year forward earnings at a 5.5% dividend yield, and nobody wanted to touch the stock because everybody assumed it has gone X growth. But nobody was willing to look into the fact that why is it gone X growth? Or has it gone X growth, or is this a transient period of time because for some reason rural is not firing? Second derivative thinking, why is rural not firing? You can't simply just say that rural is not firing and one day it will come back. But why is it not firing? What has happened to rural and why would that come back? These are the kind of questions and the kind of work that we believe is extremely important when you're looking at stocks. Then what are the remedial measures being taken, either by the industry or by the company or in general in the economy that will result in this demand coming back for these stocks or whatever? The mispricing essentially going away because the fundamentals are reverting to what is supposed to work normally in the company. And that's the important thing as well. We do generally assess an approximate timeline. 6 महीने में होएगा, 9 महीने में होएगा, 1 साल में होएगा. We don't have the luxury of sitting and invested and hoping for something forever, but essentially, how much time does it take to play out? Perfect example is MCX. MCX, around the 63 moon crisis, for 5 years, there had been no growth in revenue and no growth in profits. That is because they had introduced few options 5 years ago, and they had made options free. Whatever the growth was being taken up by options, futures was just flat, and this was there for 5 years. At the point where you started to see the options volume inflection be large enough, what happened was they went through this 63 moon crisis, and the market just punished the stock. The stock had done nothing. It was at about 1,500 rupees for a while. And our understanding on when we looked at it and the option pricing came back and the inflection point and the volumes of the F&O side came back was that this is the real, it's a really a critical juncture, turning point in the company. The 63 moon saga, in our view, what had happened was a vendor had moved, they had brought TCS in terms of the best possible IT vendor they could have picked. They did pick. It was a question of maybe a quarter or two, but essentially we were confident enough that a pedigree of TCS would be able to solve for all the issues that were there on the tech side. So therefore, 63 moons was gouging them. It was a one-time hit that you had to take. You couldn't assume this would be a permanent damage to the multiple of the company. Rest, as they say, is history, but according to me, that was a time where basically the stock price was significantly below the intrinsic value of the company, and it was an opportune time to try and buy something like MCX. Again, it comes down back to there is no alternative to the hard work that goes into getting to know your companies. In a alpha-driven stock idiosyncratic portfolio, you have to build conviction. You have to know your companies. There is no alternative to kicking the tires, as we would put it. Stay away from the Me Too players, makes you understand what are the moats and the competitive advantages your company has, which allows you to own it and allows them to come back from where they are, essentially, while going ahead. Just, in the interest of time, auto finance models, gold financing models. If you ever go and visit the branches of gold financing models, you will realize why banks are not able to do this extremely well. Bank branches are large branches on the ground floor of large shopping complexes, main roads, etc. If you and I are ever going to go somewhere and pawn our gold, our family jewels, so to speak, we ain't going into a main branch of a main locality where we're meeting our neighbor and we're meeting somebody else on the side. Gold financing branches are on the first floor, hidden somewhere in a shopping complex of a large area. And that is critical to one of the reasons, other than the fact that in a bank you go, there are 20 people, you're not able to see what is happening in terms of the valuation, the security, etc. Here it all works pretty seamlessly. And it is a business where the gold finance, the gold NBFCs have done it significantly better than the banks sustainably over a period of time. In our business, it pays to be away from the consensus, right? Efficiency only works when it is not a crowded trade, when you believe something that is different from what the market is believing in at that moment, right? And that is key to what we do. My team often tells me that I have a female gaze in a very crowded male environment, and maybe so. And maybe I take onus of that from what they say. But I think from whether you look at Hero or whether you look at Bajaj, I think it's a question of when 2.5 years ago we looked at these companies, they were not consensus. It was a trade where everybody was worried about Ola, worried about etc., all that happening. And I believe you have to be strong enough to stand away from the consensus on that front. What we don't do, what I don't like to do, and I don't believe I have the expertise to do, is invest in broken balance sheets. Because I don't have the strength or the bandwidth to recapitalize those balance sheets and turn the companies around. It's not my general expertise, it's not what I know how to do, and it's not what we generally invest in. So what do we do? Primary return driver is stock alpha. We are market cap agnostic, so large cap, small cap. Right now, I believe large cap is the place to be. I see more opportunities there. Tomorrow, if small and mid cap correct and I see the opportunities there, I will go back there, right? Benchmark agnostic, I do not care about the benchmark. That's not something I'm looking at when I'm building my portfolio. Bottom-up stock picking with a high conviction portfolio. And this graph just is proof that our stock return is driven by stock idiosyncratic risk, which is mainly that it's stock alpha over the years and not market momentum or a market style of either being growth or value. And this is again a quick chart, just in general, that we've delivered over time where we do not have any correlation to either being large cap or small cap or value or growth. Small thing, Ashmore is an emerging markets manager. We manage money only in emerging markets. A lot of it is debt. We do blended debt, external debt, some amount as equities. We have a very diversified investor base all over the world, Americas, UK's, Middle East, Asia Pacific, as well as a very diversified investor type, from HNIs to institutions to insurance to public pension money to all of that. And yeah, that's about it. Thank you so much.